So first up, are you in line with consensus? Are you expecting the bank to maintain its position on interest rates come this afternoon?
Yeah, I agree that I think that my view is that the Monetary Policy Committee will maintain the rate at 18% on the basis that the significant rate hike that was done in December, the effects are yet to be felt in the market, although we have seen an easing of inflation. But I think it hasn't been to the levels yet that would have a direct and a significant benefit to the economy. Inflation eased slightly in January to 18.3%, but I think the view would be that it would have to decline further for any change in the stance, in the monetary policy stance.
Especially where you've got the central bank and government targeting inflation to slow to about that 10% level within a year and ease to 5% in the fiscal year ending June the 30th, 2015. Just how viable targets are those that have been set, Einstein?
I would agree that they are quite ambitious targets. But we've, in the last few months, we've actually seen some of the reasons why the factors that contributed to the significant rise in inflation changing direction. One, I think, is the exchange rate. The other, of course, is also the issue of the prices of international crude oil. If we continue seeing further easing towards that, and if we are able to see a significant improvement in performance for the agricultural sector, and these and other factors, we are likely to see that target achieved, although I would say it's quite an ambitious target. But I think progressively, if the factors that contributed to the rise in inflation that we saw last year continue to ease, then I think we would be well on our way to achieving that target.
Of course, that way we've got inflation targeting the mandate at this stage. We've got to consider growth and the kind of growth that's filtering through in Kenya at the same time, Einstein. So what's your forecast looking like for this 2012 period? Because certainly when it comes to the developed world, central banks are under pressure to lower rates to support the economy.
Yes, I agree, and I think the fact that the reason the central bank has to be, of course, very cognizant of the fact that you have to maintain a tight balance between, easing inflation and also ensuring that you're able to support the growth in the economy. So already we have seen that the rise in interest rates has really affected the growth of private sector credit. And that is why I think some of the measures that the Monetary Policy Committee took was to ensure that they're meeting on a regular basis, and also in order to make sure that a lot of these targets that are set in terms of ensuring that the rise in rates is not affecting the performance of the economy in terms of growth. It's a delicate act, but you can see for now we've seen that from what happened last year, the impact of inflation and the turbulent currency has had a very significant effect. So there's also reason to ensure that that tight balance is maintained. But I agree with you that it's very important also to make sure that, on the other hand, that you're also supporting the economy through the availability of credit.
Let's just hone in on the availability of credit and the kind of lending that is taking place within the private sector arena over on that end, Einstein. When it comes to the banks right now, what stance have they adopted? Because certainly when rates were coming down, there was quite a disparity between the kind of lending rates the banks were putting out there compared to where that repo rate stood.
I think if you look at last year, towards the end of last year, after the Monetary Policy Committee raised the rate significantly, there was a lot of concern about the impact it would have on borrowing. And one of the concerns, of course, was about the growth of credit and also the potential impact in terms of non-performing loans on the banking sector. And therefore, the Treasury and the Bankers Association, as well as the central bank, had to sit down and come up with a program in terms of how the banking sector would restructure the loans that they have provided existing clients to minimize the impact of that significant rise. So what's been happening is really, I would think that for the banking sector, they have obviously been very careful in terms of, for instance, the sectors that they are looking at in terms of lending. Probably likely an inclination towards, especially if you look at what happened last year, export-driven businesses. But I think all the banks are generally being very careful in terms of their lending, because of the need to ensure that they are able to operate profitably in this current interest rate environment.
Where they're wary of just how they're lending and who they're lending to. You mentioned and alluded to the fact that we're seeing the restructuring of loans as well coming to the surface. To what extent, how exactly are we seeing restructuring taking place?
I think one of the ways that is happening is really in terms of the extension of the repayment period. For instance, if you look at a lot of the unsecured loans have tenures of up to maybe 3 up to maximum of 4 years. So we've seen situations where rather than have the client or the customer have their monthly repayments increased, it's actually the repayment period is actually increased, say, from 4 years to 5 years. So from a cash flow perspective, it's much easier for the borrower to shoulder that additional cost. So that is one of the key measures that the banking sector has taken to try and ensure that they protect, they don't incur significant losses, and that the borrowers do not suffer significantly as a result of the increase in the interest rates.
Well, certainly something that's surfaced right here in South Africa as well, specifically when it comes to the financing of new vehicles. Einstein, let's leave it there. Thanks so much for your time and your insights this afternoon.